Hello, this video is over credit and credit policy. I'm your professor, Dr. Stephen Haggard. So what is credit? Anytime we send products to a customer with the expectation that they pay us at some point in the future, that's credit. If we expect them to pay for it right now before we give it to them, that's cash. And the majority of American business actually occurs on credit. That is, between businesses. So why do we offer credit? We don't want to offer credit any more than we want to hold inventory because offering credit costs us money. Keep in mind that we've got a cost of capital as a company that we're having to pay for the money we have, and then we're turning around basically and loaning it out to our customers at zero interest. And so yes, it is costly to offer credit. And not only that, we have to worry about people not paying their bills because after all, people are scumbags and they may not pay. We would be so much better off if our customers paid cash when they bought things from us. So why in the world would we do this? Well, if there weren't any competitors that were offering credit, we could get by with not offering credit either. The problem is something called the prisoner's dilemma. So I'll take you back to some basic game theory. The prisoner's dilemma is where two people are involved in a bank robbery. And those two people get caught by the police, but the police don't have enough evidence to convict them without their confession. And so what they do is they take them into separate rooms and they tell them, if neither one of you confess, we don't have enough evidence to convict you and neither of you will go to jail. However, if one of you confesses and the other one doesn't, then the one who confesses will get 5 years and the one who does not will get 10 years. So what is the rational outcome to this? Both of the robbers confess because they can't trust their compadre not to rat on them. Now, if you don't believe me and you think there is honor among thieves, I have a friend who did 7 years in federal prison, and he once told me that he was in prison with a lot of people whose mothers, brothers, fathers, sons, sisters, daughters had ratted them out in exchange for a lighter sentence. So don't believe that some random partner in crime that you might associate with would not do the same thing to you. Now, what does this have to do with our situation? Well, we know that neither competitor would like to offer credit, but if one of them offers it, then the other one has to as well. Otherwise, they will end up losing sales. So let's talk about the terms of the sale. So when we extend credit, we have to tell people when they need to pay us back by. And we might also extend them a discount to try to stimulate them to pay their bills earlier. We have to tell them also how long before they have to pay the bill in full. And so the first thing we'll talk about is the credit period. And that would be the amount of time till they have to pay the bill in full. If we offer a discount, the discount is stated as something along the lines of 2-10, meaning they get a 2% discount if they pay in the first 10 days. And then we say net 30. That 30 is the credit period. And what does the net mean? If we don't take the discount, then we have to pay the full amount on day 30. And the terms might simply be cash. One time I was buying a fancy office chair for my wife because when people love each other very much, that's what they do. And I asked the girl when, so the chair was going to take 6 weeks to come in. I said, do I pay now or in 6 weeks? And she said, you pay now. I said, fine. I said, do you accept credit cards? She says, oh, she says, we're actually very open-minded about payment. It can be cash or check. In other words, their terms were cash. They did not accept credit of any variety whatsoever. So what are credit standards? When we decide whether or not to extend credit to customers, we need to have a set of guidelines, things that we expect of our customers before we're willing to extend them credit. And that would be our credit standards. And they might have to do with their payment history. In fact, in American business, we have a service called Dun and Bradstreet, and they will gather information on how often companies pay their bills on time and how far behind they are if they're not paying on time. And so we might be able to establish credit standards based on the information that we get from Dun and Bradstreet. We might also be able to look at the financial statements of a firm if it's publicly traded and use some financial ratios as our measurements for our credit standards. And that leads us to credit analysis. We're going to have to look at these companies and all of their different numbers to determine what is the probability that the customer will repay. And our credit standards will place a lower bound on the probabilities that we would expect, that we would accept. Assume that we would accept people who have a 95% probability of paying. That means we're going to have fewer customers that we'll extend credit to than if we also took people down to 90% probability to pay. And so the tighter your credit standards are, the fewer customers you'll have and the lower your sales will be. But on the upside, you'll also have far less bad debt to write off. And then we need to think about our collection policy. In a perfect world, our customers would simply just pay their bills on time, which is exactly what I encourage you to do. But sometimes companies get themselves in a situation where they cannot pay, and sometimes they just choose not to pay, because after all, people are scumbags. In fact, I have a friend who did some electrical work for an architect, and the architect said, well, I will get paid as soon as the customer pays me. Well, the customer turned out to be the local school district, and it turns out my electrical engineer friend had friends on the school board, and when the architect kept telling him that he hadn't been paid, he said, don't worry, I'll reach out to my friend on the school board, we'll get this taken care of. And immediately the architect said, your check's in the mail. The architect had been lying the entire time about the customer not paying their bill. So our collection policy, what are we talking about there? We're talking about monitoring the receivables. That means we need to keep an eye on who has been paying their bills and who hasn't. And we need to work on obtaining payment on past due accounts. And this goes all the way from people basically just sending another bill 1 month later, which is pretty lame, all the way down to people calling up and asking for the money, which is what I would recommend. Now, if things get really bad and you don't want to do business with this customer anymore, which would be totally understandable, then you could turn this bill over for collection, but you won't get as much. You'll only get pennies on the dollar, but you might get something. Okay, now let's talk about who comes up with our credit policy. It's the entire executive committee, and here's why. If we put the sales executive in charge of credit policy, they will want to have a very loose credit policy so they can sell the absolute most that they can. Because after all, salespeople get paid on commission, and they hardly ever get hit when their customers don't pay their bills. Now, what if we ask our finance person to do the credit policy? Well, they would probably want to minimize the number of customers who receive credit from us, because that would minimize our bad debt costs. It would minimize our collection costs. And so we need to find some sort of happy medium there. And that's why it's important to get all of our executives in the room and come to some sort of understanding about what's actually good for the shareholders. And of course, that's the goal of financial management, to maximize shareholder wealth. Now, who administers this policy? It would be the credit manager. The credit manager, using the policy, makes decisions on to whom to extend credit and how much they can buy on credit. When I was in sales, I landed the world's biggest blow molder as my customer. And I went to our credit manager and asked him how much I could sell to these people on credit. And he told me that I could sell them 500 pounds worth of our product. And I told him that 500 pounds was only about 2 hours production run for these people, and we needed far, far more than that. After some arm twisting, I was able to convince him to allow me to sell more to them on credit. Why was the credit manager not interested in extending these people credit? Well, it was the first time we'd done business with these people in around 20 years, and even though they had a sterling reputation and great financials and a good Dun & Bradstreet rating, he was still risk-averse and did not want to jump in with both feet when it came to extending them credit. So let's talk about the terms of the sale. In our basic form, we've discussed that it's 210 net 45. 2 meaning a 2% discount. 10 meaning you get the discount if you pay in the first 10 days. And if you don't pay in the first 10 days, then you have 45 days to pay the full amount. So let's give an example here. If we buy $500 worth of merchandise with the credit terms that we just talked about, if you pay in the first 10 days, then you get 2% off. 2% of 500 is $10, so you'd only have to pay $490 if you paid in 10 days. But what if you wait till day 11? Well, now you owe the full 500. So would it make any sense to actually pay on day 11? No. What you want to do is wait till the end of the period, the 45 days, and then pay the 500, because otherwise you're missing out on the time value of that money. Now let's talk about how to calculate the implied interest rates when customers do not take the discount. So the credit terms of 210 net 45, we just discussed what those mean. And there's another way you can think about this. That 2% discount, if you don't take it, it's in essence, the 2% turns into interest. And that interest is used to borrow the 98, because you could have paid the 98 on day 10, and now instead you'll be paying 100 on day 45. And that 100 represents 98 in principal and 2 in interest. So if we take 2 divided by 98, that gives us our period rate. The next question is, how long is the period? And the answer is 45 minus 10. So why not 45? Well, you're not actually borrowing that money for the first 35 days, but you are paying that interest on them for the last 35. And we know we want to go all the way out to day 45 if we are going to pay the full amount. And by the way, if we're going to take the cash discount, we want to wait as long as we can within the discount period to do that. So that would be 10 days. Now we can figure out how many of these 35-day periods there are per year. It's 365 days in the year divided by 35 days. Tells us that we have 10.4286 periods per year. And then we can use the effective annual rate formula to figure out what is the implied interest rate when the customer does not take the discount. Let's take a look with the calculator. If we take 2 divided by 98, that gives us the percentage we find here. And then we can add 1 and then raise it to the power of the number of periods, which is 365 divided by 35, close parentheses, equal. Now we have to subtract 1 and then multiply by 100. What this really means is that our customer is paying an interest rate of 23.45% on that money. If they took the discount, if they could borrow that money for less than 24.35, they would be better off to do so. Let's say they could borrow from their local bank at 12%. They would be better off to borrow that money on day 10, pay the bill, and then pay the bank back at the lower interest rate. What kinds of companies benefit from not taking the discount? How about extraordinarily risky ones? Ones that don't have access to other funds. These would be the people who would benefit most from not taking the discount. Now let me show you one more way to do that. So we have second and the number 2. And if you look above the number 2, you'll see it says ICONV. And if we take 2 divided by 98 equals, we get our percentage there, but we have to multiply by 100 because these keys actually work in percentages, not decimals. And then we are trying to get the APR, so we need to multiply by the number of periods. So I'm going to multiply by 365 and then divide by 35 and hit enter. That's our nominal rate. Now I'm going to arrow up here and look for compoundings per year. That's just once again the number of our 35-day periods per year. Got to hit enter, and if I arrow up and compute, I get exactly the same answer that I did from using the formula. It really doesn't matter which way you do this. They are both perfectly fine. So the company actually benefits when customers choose to forgo the discounts as long as the company is able to borrow for less than 23.45% in this case. I would be thrilled to borrow money at 10% and turn it around and loan it to my clients at 23.45%. Now let's talk about the cash flows from granting credit. When you make a credit sale, you do not receive cash. You receive an accounts receivable. And then at the end of the terms, whenever they decide to, they mail the check to you, the customer does. Do you have the cash now? No, it's still in the mail. And now it shows up eventually in your mailbox and you deposit the check. Now this is a little quicker than it used to be because we can now electronically deposit checks and you can get the money quicker that way as opposed to waiting and taking your checks down to the bank. But your money's still not available. If you've ever done this, if you've ever deposited a check, watch and see how long it actually shows up to be available for your use in the balance of your account. It's usually around 3 days. It's 1 to 3 days until that cash is available. And so this is the amount of time it takes from the credit sale until the cash is available for you to be able to use that cash. So let's talk about our investment in receivables. And a lot of people don't understand that it truly is an investment. Our accounts receivable is equal to our credit sales per day times the average collection period. Now, why are we saying that accounts receivable is an investment? Well, we are making that investment in order to get an outcome that we desire, which would be additional sales. But it's going to cost us money. It's going to cost us money to do that. In other words, we have to get that money from somewhere in order to be able to float our customers. The greater the credit sales per day, therefore, the greater the accounts receivable, and the longer the collection period, the greater the accounts receivable. And so there are basically two ways that we could lower the accounts receivable. One would be to lower our credit sales per day. Well, that might not be a good idea, because if all of our sales are on credit, and then lowering our credit sales per day just means lowering our overall sales per day. It would be so much better to do it by lowering our average collection period. If all of your customers are paying on time, the only way you could do that would be to reduce your terms from, say, 30 days to 15 days. But at that point, you might find yourself alienating your customers. What is better is to go after your delinquent customers to get them to pay their bills sooner. And you will always have delinquent customers. So if a firm sells $1,000 a day on credit and collects in an average of 30 days, how much would the firm have in accounts receivable? Well, it would be 1,000 times 30, so 30,000. And we've already discussed what we would recommend for the firm to do to lower their accounts receivable. Now we have to be careful and monitor our receivables position. So if you are a manager at the firm, or if you're an investor, you should pay attention to accounts receivables management to avoid potential losses. Let's talk about it first from the manager's standpoint. If your accounts receivable is growing out of proportion with the growth in your sales, that means that either we have some people who are being delinquent in their payments, or we have been loosening our credit terms. But what if you're an investor, a stockholder, a lender, a bondholder? What would you do then? Why would you care? Well, sometimes what we see is that management, in order to hit their numbers for sales goals, will actually loosen their credit terms and slack off on collection. And they do this to increase sales. But the problem is that eventually these sales will turn into bad debt. And so we have to be careful. If we see a company that is maintaining or increasing sales, but their receivables position is growing much faster, then that's a sign that there's something wrong. I'll give you an example. There was an American company called Bausch & Lomb, and they made machines for laser eye surgery. And laser eye surgery was a big deal, and every eye doctor who was interested had to go out and buy one of these machines. And the sales just grew and grew and grew. And so Bausch & Lomb assumed that the sales would grow forever. But it turns out that each doctor only needs one machine, and there are only a fixed number of doctors in the United States who want to do that kind of work. And so after a while, they had sold machines to every doctor in the U.S. who had good credit. And so what did they do in order to be able to keep hitting these sales goals? They loosened their credit. They started selling to doctors with worse and worse credit so they could keep shipping the same number of units per month. And of course, in the beginning, everything looks fine. But then the doctors become delinquent on their payments, and we start to see the chickens come home to roost. Now, there's also the possibility that the deterioration in the receivables position can be unconscious. I'm fond of saying what gets measured gets managed, and it is so true. If we are not measuring something on a regular basis, there's no way we can manage it. But sometimes, even when we measure something, we are still not managing it. I was working with a client here in town, and they had a problem with their receivables position growing. And basically, they had not even noticed that this was going on. They're smart folks, but they've got a lot of things on their mind, and if you're not careful, this receivables position can be one of those things that slips from your mind. So let's talk about days sales outstanding. Days sales outstanding is also called the average collection period, which we've already talked about, which is the same thing as days sales in receivables. In finance, we have many names for the same thing, and we use the same name for many things, so you have my apologies. But these are the three things that all mean the same thing here. So, here is an example. A firm has credit terms of 210 net 30. 70% of customers take the discount, the rest pay on day 30. What is the firm's days sales outstanding? Well, 70% are taking them after 10 days, so that would be 0.7 times 10, and 30% are taking them on day 30, so that would be 0.3 times 30. 0.7 times 10 is 7, 0.3 times 30 is 9, and so when we add those together, we get 16 days. Now, I want to point out something strange here. Notice that none of this company's customers are paying late. That would be so rare and such a wonderful outcome, but don't expect to see this in your own firm. So the firm's annual sales are $39,600,000. What are the average daily sales? Well, it's easy enough to find. We can just divide by 365 and find that the average daily sales are 108,493. Now, we're going to make the implicit assumption here that all of those sales are on credit. And if we are involved in some sort of B2B, that is business-to-business relationship, then this totally makes sense that all of those sales are on credit. And so in order to find out how much the firm should have in accounts receivable, all we need to do is multiply that average daily sales times the days sales outstanding. And we would see that we would have somewhere around $1.7 million in accounts receivable. So what does the days sales outstanding tell us? Well, we can compare our firm's DSO to other firms in the industry. Remember that you can calculate DSO using publicly available information from the balance sheet and the income statement. All we have to do is figure out the accounts receivable turns by taking sales divided by accounts receivable, and then take 365, divide by those turns to get the days sales outstanding. And so we can look at ours versus other people in our industry. If everybody else has 30 and we have 60, maybe it means that we are being too generous with our credit terms. If our credit terms are 60 and we're getting paid in 60, and our customers, our competitors, are getting paid in 30 days, it probably means they have 30-day terms. Now, we could make one of two choices. Either we could choose to exploit this difference and advertise to other people that we give better terms, or we could pull back to the industry standard 30 days terms and basically cut our accounts receivables in half. Now, what if our days sales outstanding are 60, but our terms are 30? That means that our clients are taking advantage of us. They are using us as a zero-interest bank, at which point we need to start calling our clients to try to get paid in a timely manner. In fact, that's what managers can do to reduce days sales outstanding. Students often say, oh, wait a minute, let's just offer them a discount to pay early. Wrong. That costs us money. And remember that we're usually better off if the customer bypasses that discount anyway. So what do we do instead? My very best advice to you is to pick up the phone and call everyone who's delinquent. Now, be polite, but ask them to pay their bill. And when you figure out that people are serial offenders, try calling them on day 29 and saying, hey, Frank, we're sending you a bill. We've sent you a bill. We just wanted to remind you that we are expecting your check shortly. You'd be amazed at how well this works. Now, another common student answer is turn it over for collections. And there are two problems with that. Number one, when you do that, you typically only get pennies on the dollar. And number two, you've alienated a customer for life. So don't ever do that until you've lost all hope of getting paid and you never want to do business with that client again. Now let's talk about the aging schedule for receivables. It tells you how much of your accounts receivable is in each bucket, where the buckets are in number of days beyond the sale. And so the first bucket that we look at is all the stuff that is still within discount days. So let's say you've got 210 net 30. Everything within 10 days would be considered part of this discount bucket. Anything older than 10 days, but 30 days or less, would be in the remainder of the credit period. And if you're in either one of those buckets, then you are still okay with your receivables because there haven't been any promises broken yet. But all the buckets beyond that represent an increasing severity of past due. Usually you'll see 60, 90, 120 days as the additional buckets. Now we can only put together an aging schedule for firms which we have the every transaction information for. And so most likely that just means it's going to be your firm or a firm for which you are doing accounting work. I cannot use the balance sheet, income statement, things like that to come up with an aging schedule for a competitor. So here are a couple of aging schedules. One is for a company called Supersets. And Supersets and its competitor Wonder Vision both have exactly the same value of accounts receivable. But I would say that Supersets is in much better shape because everybody at Supersets is still within the credit term period. However, at Wonder Vision, we see that 17% are past due. In fact, 2% are more than 60 days old. By the way, the older an account is, the more likely, the more past due an account is, the more likely is you'll never get paid for that. This 2% that's over 60 here, there's a good chance that I would turn those people over for collection after giving them one last chance to pay. So let's talk about analyzing some proposed changes to our credit policy. If we ease our credit policy, it should have several effects. The effect that we're looking for is increased sales. That's the only reason we would ease our credit policy. Now, if we have increased sales, our costs will rise. Not in a bad way, just because we have to have additional materials to meet those additional sales. So I'm not concerned about that increase in cost as long as we have a positive marginal contribution for every item we sell. Our accounts receivable is also going to increase due to the increased sales. Even if we don't give longer credit terms, definitely if we're selling more, we are going to have higher accounts receivable. But additionally, if we have longer credit terms, we will see a higher days sales outstanding, and as a result, we will see an increase in accounts receivable. And bad debts can rise if we are granting credit to less credit-worthy customers. Remember that when you start to move down the credit quality chain, your chances of the customer defaulting increase. And as that probability of default goes up, so does your potential bad debt. And then finally, the discount expense will rise if you increase the discount percentage or the discount period. So let's calculate the costs of credit policy changes. So we have this example firm, and they are easing their credit policy, and they're doing a number of things. They're extending the credit period. That would be the amount of time that the firm has to pay in full. They are increasing their discount. They're relaxing their credit standards, and they are easing their collection effort. And they're changing their terms from 110 net 30 to 210 net 40. So that's the extending credit period and increasing the discount. Currently, the firm has $400 million in sales. 50% of those people pay on day 10, 40% pay on day 30, and 10% pay on day 40. Now notice this firm has people who are past due. That is more representative of what happens in the real world. So what is our current day sales outstanding? Well, half are paying on day 10, 0.4 on day 30, 0.1 on day 40, and when we do the multiplication and add all those products together, we get 21 days. And our discounts at present, remember that half of the sales are taking the discount, so that would be 200,000 times, or 200 million, times 0.01 would give us 2 million in discounts. That's the expense, that's the money we're not collecting now as a result of those discounts. Now our accounts receivable carrying costs, it gets a little more complex here. We know that accounts receivable costs us money, and you might be tempted to think that it's the entire amount of accounts receivable that costs us money, but it's actually just the portion of those accounts receivable that are variable cost. Because of course the fixed costs that are associated with those products, we're going to pay them anyway, so they're not incremental. So the variable cost ratio would be the variable cost divided by the unit price. And then we're going to multiply that by the cost of money used to carry receivables. In other words, what kind of interest are we paying on the money we have borrowed to enable us to extend this credit to our clients? And so the ARCC, accounts receivable carrying cost, is DSO times daily sales, because that is total sales multiplied times the variable cost ratio times the cost of funds. Here we're told the variable cost ratio is 0.7 and the cost of funds is 20%. And so we can do all that multiplication. By the way, the daily sales for this firm, 400 million, divide by 365. And when we do all the multiplication out, we come out with 3.22 million, or around 3 million. Let's just call it 3 million. And we've already discussed why we only include the variable cost portion. And it's because those fixed costs go on whether we sell 0 units or 1 million units. Currently, 2.5% of our sales go uncollected. That's bad debt. So, how much are we talking in terms of dollars? Well, 0.025 times 400 million tells us that we have 10 million in bad debt losses every year. So now we're going to make this credit policy change. We're going from 110 net 30 to 210 net 40. And we see that we have a larger discount and a larger payment period. Also, we are relaxing the credit effort and lowering our credit standards. Now, why are we doing this? We're doing it for the sales increase of 130 million here. Now, I want to point out that this number, 130 million, is an estimated value. That's just a number that someone has predicted. It's our very best guess, but it's still just that, a guess. Management thinks that 60% will now take the discount. Once again, that is just a guess, with the other half of the non-discount payers paying on day 40 and the other half paying on day 50. So the discounts, the accounts receivable carrying costs, and the bad debt losses will all increase as a result. But our collection expenses will decrease. Why? Because we are relaxing our credit efforts, our collection efforts. So the new amount of the discounts is going to be 2% times the new sales level times the 60% management now thinks will take the discount. And so our new amount of discounts comes out to be around $6 million. And our new days sales outstanding is going to be 24 days. How did we get that? 60% pay on day 10. And so the remainder is 40%, and they said half of that is divided between 40 days and 50 days. So 0.2 times 40 plus 0.2 times 50 gives us 24 days. And our new accounts receivable carrying cost would be 24 times our new average daily sales, which is 530 million divided by 365, times our variable cost portion, times our carrying cost of accounts receivable. And so our new accounts receivable carrying cost is around $5 million. Now notice we're rounding these to the nearest million. Remember that all these numbers are just guesses. Sometimes students get hung up on thinking that we know exactly the dollars and cents that are going to happen here. We don't. We're making ballpark guesses. We do know the company is going to reduce its credit analysis and collection expenses by $3 million. And we predict, once again, just a guess, that bad debt will rise to 6%. And so our new bad debt losses are going to be 0.06 times our new sales level, or 32 million. And so now let's put all this together to see what is the impact on net income. The key question we're looking at here is, will the increases in sales revenues be offset by the increased costs? Well, let's take a look. We start at the top. We think that we're going from 400 to 530, so that's an increase of 130. But we're going to have additional discounts of 4, and so our increase in net sales is actually only 126. And we know that our production costs are going to go up by 91. And so our profit before credit costs goes up by 35 from the old scenario to the new. But what are our credit-related costs? Well, there's our cost of carrying accounts receivable. It's up by 2. And there is the amount of money we are spending on credit analysis and collection. It's actually down by 3. And so we can also look at our bad debt losses. It went from 10 to 32, an increase of 32. And so if we take 35 minus 2 plus 3 minus 22, it gives us 14. Let me go through that one more time. The credit-related costs are 24 minus 3, or 21. 35 minus those costs of 21 gives us an increase of 14. So our profit before taxes goes up by 14. Now, as long as our tax rates are something less than 100%, that means this is a good plan. But our taxes here, they're really only 50%. So basically, we could expect our net income to rise by 7. Now, the question is this: is 7 enough to warrant all of the risks we are taking, knowing that these numbers are all just guesses? And that's one of those things, a skill that you will develop over time if you get into this line of business.